Hey, welcome. This is for Chapter 11, the basics of capital budgeting. I'm going to do this lecture a little different. Instead of going right to the Sim Excel sheets, I'm not going to even open it because this is fairly easy. I'm going to go through this lecture, and what I'm going to do is I'm going to show you how to do every single thing in this chapter that makes it very simple. So, a couple notes is go to the PowerPoint. If you want to download the PowerPoint, go to this section where it has project L and S, and you can copy that and throw it into Excel. I'm going to be going off those numbers if you want to practice, or just use the numbers and type it in. So it's fairly simple. So let's look at, here are the numbers that we have. We have two different projects. So I'm going to go through it, and then I'm going to show you every example. You follow what I do. It's very simple. And then you could follow the Sim Excel sheet where you can just upload it once you have it completed. I might have to pause this video, pull it up for the last question. Maybe we can go through the last question. So a couple things we want to know. What is the WAC? I believe we did was 10%. So we have two different projects here. We got Project L and Project S. And I'm just going to make these the same font. And what these are, you want to know what is the rule for capital budgeting is if we have a positive net present value, what we want to do in this example, we're going to do that. We're going to do the IRR and the MIRR. But the first thing we want to do is if it's a positive, we've done this before, a positive net present value, which is greater than zero, you accept the project if it's by itself. If you're comparing it with two different projects, then you choose the one with the highest one. So what we have is here's the years. Here are the cash flows. We have an upfront cost of a -100, and then we have positive cash flows. Well, that's based off of a WAC of 10%. We want to know if we receive those cash flows, is it a positive net present value? So how do we do this? We're going to go equals. Just remember, net present value function is the year zero is already in the present. Therefore, we are going to do equals net present value. You want to read what it says below. So we have the rate is the WAC. We're going to discount all future cash flows according to the WAC. And then we want to know the values. Well, the values are, by definition, the net present value is all future cash flows into the present. So what I want to do is highlight all the future cash flows, which means the cash flow, the negative at time zero is not in our function because that's already in the present. If you highlighted times zero, what that means is that you're assuming that's at time one in the net present value. So it's going to make your cash flows inaccurate. So what we're going to do is we're going to close that up. And then I'm going to say plus that cash flow. So it's outside of the function of net present value. All right. Some reason it does a percentage. So I'm going to change that to a currency. So what we have here is a net present value of 1878. We would accept the project if it was by itself. So let's do the same thing with this one. We want to find the net present value. Again, we want this outside of the function because it's already in the present. And I'm going to say plus net present value. And then I do the rate, comma. So the net present value for project S is 1998. So if we had to compare the two, we would choose S. Or if it's just standalone projects, we would pick both of those. But if it's mutually exclusive, which means we're only going to do the one that's the best projects, I would choose the one with the highest net present value. If it was less than zero, I would not choose it. So some people ask, why would you choose a project that you make $1? What that means is we're making $1 more than a 10% return. So if we had a net present value of zero, that means our project is exactly 10%. And if it's greater than that, we're making more than 10%. If it's less than that, we're making less than 10%, what it means. Okay, the next one is the IRR. That's the internal rate of return. And I have to define what it means. The internal rate of return is the rate at which the WACC would give you a zero net present value. So let me explain further. So this is fairly simple. All you do here is just type in equals IRR, and that's the function. And all it asks for is the cash flows. Now, the big difference is, if you notice, I did include time zero in the IRR, but I didn't with the NPV. So what you want to know here is NPV is the only one we do not put in time zero. All other functions we do include it. So that's important to see. All right, so we're going to do the IRR, internal rate of return. And that can explain it further as we see what it is. So project L has 18%, so I'm just going to drag that over. And project S has 24%. What does that mean? I'm going to make the decimals a little further out. What does that mean? It means this is the internal rate of return at which, if our cost, in other words, if our cost was at 23.564% for that project, that means our net present value would be zero. That's the definition. This is the internal rate of return at which the cost, if the cost was at that rate, net present value would be less than that. So how do you know if you would choose the IRR? Is that if the IRR is greater than the WACC, that means we got a positive net present value. So you see the WACC is 10%. Our internal rate of return is higher than that. That means we're making money, and we are making money, right? We are making that, and that's all it means. Here's an interesting thing. So if, I want you to think about this, I'm going to switch it back. If I said the internal rate of, the WACC was 18.13, remember the definition of it, what do you think the net present value would be? Well, it would be zero. You see that? It would be zero because the internal rate of return, it shows that what the WACC would be in order to get a zero. And then same thing here, if I chose 23.56, so I put that WACC in, that means this project would be zero, and we would lose money in this one because the WACC is higher than the internal rate of return. Therefore, we have a negative net present value. So that's what it means. Okay, a couple things about IRR. IRR will only work if you have a negative at the beginning and you have positives after that. If I have a negative cost at time 2, it would not work. It would give you multiple IRRs. Read the PowerPoint to understand that. It'll show you an example. So IRR only works if we have a normal cash flow, which is a negative outflow at the beginning with positives later on. Number 2, why would IRR be not a great teller? Number 2 is that I want you to think of a scenario is where you invest 50 cents into a project and you made $5 for each year. Your IRR would be huge. Let's do the math right here to make sense. Let's pretend, well, let me just switch this around. I'll switch it back. Let's say we made 50 cents. That's the cost of it. And we make $5 per year. Look how massive our IRR is. It's huge because we invested 50 cents and we're making $5. But let's just say instead we invested 100,000. I'm going to change this in a bit. And we're making, trying to think, make this numbers make sense, 200,000 per year. So look, our IRR is lower in this project. So if we're comparing two projects, it looks like L is the better project because it's a higher internal rate of return. However, our net present value, we made $397,000, right? So what's the point of it? The IRR might be deceptive because it shows the internal rate of return at which net present value is zero, but it doesn't show you how big the magnitude of the cash flows are. So I just wanted to show that. So I'm going to put everything back to the way it is. Okay. If we don't have a normal cash flow, let's say we have a negative somewhere else, there's something called the MIRR. That's the modified internal rate of return. And what that is very simple to calculate. I'm going to calculate is MIRR, and you say equals, and it's the same concept. So what I'm doing is I'm going to highlight the cash flows. If you remember, the IRR didn't ask for a rate because it just shows the internal rate of return at which the net present value is zero. In the assumption of IRR, we're assuming all cash flows we receive, we're going to reinvest it in at the WACC. That's the assumption we make. Well, the modified internal return gives you the opportunity to enter in the finance rate, the cost of it, and on also the reinvestment rate. So you get to play around with that, and it's going to give you a different value as well. So this is a modified internal rate of return. And I'm going to do an example to show you how that works if we had to calculate it by itself. So I'm going to do this as well, MIRR. So you know, on the exam, if you get good at this, this is super easy. All you do is you see cash flows. If you know how to type it in, very simple, especially with Excel. So it shows you Project S has a higher MIRR. So how does the modified work? What it does, it takes, let's just do Project S. I'm going to put this over here. What it does, it takes all the cash flows, the outflows at time zero. So I'm going to enter that and make it a positive. So we're just going to make it a positive. So we have one cash outflow, it's a negative 100. We got to put it at time zero. It's already at time zero. And then what it does, I'm going to drag this over one more. And okay, show how it works. And then what it does, it takes all the cash inflows, the positive ones, and we want to put that at time, the last cash flow at time 3. But we have to do the time value of money at the WACC. So we're assuming we're making 10%. So this is what we're going to do. Or the reinvestment rate. So we want to, and if we have a negative one at time 2, we want to discount that to put at time 0. So we want to discount it or compound it, but we won't put all the negative ones at time 0, all the positive ones in time 3. So what we're going to do here is I'm going, okay, this cash flow, and we need to bring it into the future, and we're going to compound it at 1 plus the WACC. Well, how many years is that? Well, if that's at time 1, we'll get it for time 2, then time 3. So I'm going to do it to the power of 2, right? That's the positive one. And then I'm going to find out, well, what is this one? This one is at time 2 for 1 year, right? I'm going to do it from 2 to the third year. That's only for 1 year. I'm going to multiply it times 1 plus the WACC to the power of 1. And then that 20 is received in the third year. I need to put it in the third year. It's already in the third year. So that's already there. So, and then that's going to be the 20. So let me sum those up. So what we have is 159.70 in year 3. That's the inflows. That's what's going to be worth in year 3. And then we're going to do the cost, and we're making a positive in year 0. So what we are saying, this is how we do the modified internal rate of return. What we're saying is the $100 these are the outflows at time 0 will be equal to, and I'm going to try to do the best I can in Excel, be equal to, I forgot, let me put apostrophe and do that. It's equal to the cash flows in year 3, the outflows, and look at the PowerPoint, they show the equation. So I'm going to go equals, I'm going to add that there. And what we want to do is we want to divide that. I'm getting all these apps I have, like the Meta popping up, so I'm getting little errors. So I want to divide that by, and this is what it's look like. Again, look at the PowerPoint, how it has it. And that's going to be 1 plus MIRR and what year is that in? To the third power. So in other words, we're saying the $100 today, the cost is going to be equal to all the cash we're going to receive divided by 1 plus the MIR to the third power. So we're trying to find out what interest rate would the outflows equal the inflows. That makes sense. And we're going to take that 159 0.7. I'm going to discount all the outflows to times 0. That's what we want to do. But what I'm doing is I already know the 159.70, so I want to solve the 1 plus the MIRR to the third power. I want to solve the interest rate. So again, pull up the PowerPoint. This is not too important, but I just want you to understand it. Those 100 equals 159.70 divided by the 1 plus MIR. So if I want to solve it, I'm going to throw the 1 plus the MIRR to the third power on this side, and I'm going to take the 100 and divide both sides. So what we're going to do is I'm going to take 159 divide by 100. That's 1.59. And now the 1 plus the MIRR to the third power is equal to 1.597. So now I got to get it by itself. I'm going to do to the third power 1 divided by 3. I need to get rid of that third power. Now we have that, and now I need to equal that interest rate, and I'm going to subtract 1 because I had 1 plus MIRR. I need to get rid of the 1, and now I have 16%, 16.88. Let's see how accurate that is. Look at that. So we solved it. So I solved the MIRR. You could do what I just did there. I want to show you what that means, but the Excel function is easier. So don't have to do what I did, but I just want to show you that. So all we're doing is we're taking the outflows at times 0. We're taking the inflows at the last year. And we're compounding and discounting and find what it is. And we're saying the outflow is going to be equal to the inflow at the same year. That's why we divide it by the 1 plus the MIR. We have to discount the inflows back to times 0. Then you can solve what MIR is. Okay. A lot of fun stuff there. So we did MPV. Okay. Next one we want to do, and I'm going to delete all this. So I make sure you understand it. Next one we want to do is what about the payback period? That's the next method. The payback period is very simple. So I'm just going to do that up here for both. The payback period is we want to know in what year are our cash flows going to pay off the original cost. So let's do this. And what we want to do is we want to add it up. So we want to say is at time 0, let me just do project L for now. At time 0, we are negative $100. However, the next year we got $10. So what I'm going to do is I'm going to take that cost plus I get 10. So at time 1, we're down negative 90, right? That makes sense. And then I want to find out, well, we're negative 90, and now we're going to add, I'm going to hit the negative 90, and now I'm going to add, we get paid us $60 in year 2. We're still down negative 30. But if you notice, we're going to get paid $80 in that year. So we want to know what year are we going to pay it off. We know it's going to take 1 year. We know it's going to take 2 years. However, in the third year, we paid it off, right? But we got more than that, right? We got paid 80, but I only owe 30. Now, if that was 80 I owe, we would say it took 3 years. But I only owe 30, and I'm getting paid 80. So what we need to do down here, I'm going to say, well, I owe the 30 and I'm going to get paid the 80. So 0.375 of that year, right, is when I officially pay off the original cost. So how many years did it take? It took 1 year, 2 years, plus 0.375. So if I go equal to plus that, so it took me 2.375 years, right? Again, this is this adding it up, the cumulative effect of all the cash flows. So I have negative 100, and then it's negative 90, and then negative 30. Now I get paid 80, so it's going to take less than 3 years. All right, that's project L. Let's do project S. Where we at time 0, we're down negative 100. Where we at here, I'm going to take that negative and I'm going to say plus. We're getting paid the 70. We're still down negative 30, but if you notice that 50 is greater than 30, so we're going to pay it off within that year. So it's going to be less than 2, but greater than 1 year. So what I want to do down here is I'm going to take, well, I still owe 30. I'm going to divide it by the 50. So we paid off within 0.6 of the year. So what is that going to be here? So we're going to pay that off within, that's going to be 1 plus that. So 1.6 years. This is 2.35 years. So project S is quicker. All right, so what is the payback period? What's the criteria on this? We know the net present value one, we know the IRR. The payback period is, we would say in a project, I would accept all projects greater than 2 years. Oh, I'm sorry, less than 2 years. So if it's less than 2 years, we would choose project S, but not project L, because it took longer than 2 years. So it's very simple. I would take all projects that we pay back within 5 years, 4 years, whatever it is, and then we would look at it and we would do it. So the benefits of this method is that it's quick and it's easy. The downside of it, I want you to think about it. What if, let's look at project S, or let's just say project L. Let's say I have to pay it back within 2 years. Well, it took me 2.375 years, so we would not accept it, right? Let's just say, what if in the 3rd year, we got a massive cash flow? Well, look at all that money we're making because in the 3rd year. But if my criteria is I have to pay it back within 2.35 years, I would reject it because it's going to take me 2.35 years. Oh, I'm sorry, if I said 2 years, it's going to take me 2.35 years, and I would ignore that massive cash flow in time 3. So just want to show that payback is very simple, and you can look at it, and as a manager, you can say, this is what I'm going to do. But the downside of it, it doesn't take an effect the cash flows that we have after the payback period. All right, last one is called the discounted payback period, and that's another thing bad about the payback period. It does not discount these cash flows. So what I'm going to do here is we want to find out. I'm going to delete all this. We're going to discount. Come on. We're going to discount the cash flows and find out when the payback period according the time value of money. That's when the downside, it doesn't take in the time value of money for the basic payback period. So let's discount it. So I'm going to take L. I'm going to do an equation so I can do it quick, and I'm going to discount it. That's weird. Hold on one second. I'm a little thrown off about something that has a name. That's kind of interesting. Okay. So what I'm gonna do is I'm gonna discount it. So I'm gonna that's already times 0, but I'm just gonna do it real quick. Why is that not working? Hold on one second. I'm all messed up here. Will equal some reason. I copied this from the PowerPoint. All right, so I'm going to take that negative $100. I'm going to divide it by 1 plus the interest rate. So I'm just discounting, and then I'm going to close that up, and then I'm going to do it to the power of that year, and we have the years here. So now I get to drag that down. I want to put in, I don't know why I should just change it to, it should be just that cell D2 and D5. That's kind of interesting. So, but I want to freeze. I'm going to freeze it. So now I get to discount all the cash flows. There we go. And then I get to drag that to the right. Well, I should have dragged to the right. Well, some reason my formatting's all crazy. Let's just discount this really quick. 1 plus the WACC. Remember, this is the present value equation here. And we should know how to do it. Right? If I discount something to the 0 power, it's the same thing. But I just wanted to do that. So, all right. Oh, I forgot the interest rate. function for, you got to freeze, making an absolute value for the interest rate. Okay, those are the discounted cash flows there. So now we're just going to do the payback period based on that. And I'm just going to do L. We don't have to do both, just to show you. Again, I want to find the cumulative aspect of each one. So this is just L. Well, at time 0, we were at -1. And then at 1, I'm going to say, okay, we're still negative 100, plus I'm going to add the 9.1 because it's discounted. Now we're negative 90.9. And then I want to add in the 49. Once you do it, you could just drag it down. I just want to show you what that looks like. Look, we're negative, we're still down, Now we're positive, so we did pay it back within that second year, but it's less than 3 years, so we got to find out what it is. So we know it took 2 years. So there's the period that shows the negative to a positive. We know that it happened within that time period. I'm still down negative 41.30, and we received a $60 and $60.1 in that year. So we want to know. So what I'm going to do is equals. If you do ABS, the absolute value, because it's a negative, have there about it. I don't really care for it. So what I'm going to do is I'm taking, that's what is owed still. I'm going to divide it by what we receive. So we get paid back within 0.68 within that time period, right? So what I'm going to do, that's going to be then equal to, it took 2 years plus that. So remember, the original one was 2.375. Discounting make the cash value not worth as much because it's into the future with the discounted by 10%. So it's going to take me 2.68 years. And if my criteria is 3, I would accept it. If my criteria was 2 years, I would reject it. If it's a project, if it's a project by itself, exclusive with some other project, I got to choose the one that's the greatest. I would choose the quickest one. How that works. All right, give me a second. I'm going to pull up the Excel sheet. I will do that last problem. Chapter 11, Sim. And you'll see it. You should blow through it pretty quick if you follow this lecture. And just I'm going to kind of puff up a few things about myself here. Is that if we were doing a calculator, you would hate me because it's much more difficult. Excel is so simple. So hopefully you see how easy it is. You have to understand the function and what it means. So let's go to the investment decisions. Let's just do this one. We got we got 2 projects, S and L. And we want to compare these, and we're going to show the loss value. So what we're going to do is let's do S first. Let's do the MIRR. So I'm going to do the MIRR for S. Remember, it's all the values highlighted. Why is it saying that? Oh, I keep on forgetting. You got to deal with MIRR. We're just to make the assumption that the WACC and the reinvestment rate is the same. 9.12, and then I'm going to go equals. We'll do MIRR. And we'll do the next one, comma, interest rate. Comma, interest rate. Close it up. According to this one, we would choose project L. Now let's do the IRR, internal rate of return. We'll see if we get the same result. This has got to be the easiest one. Just do that real quick, and all I have to do is drag it down to do the next one. Look at that. The MIRR, the modified internal rate of return, I would choose project L. But according to the IRR, I would choose project S. So they're giving me conflicting things. And it has to do with the size of the cash flow. Is that one, you're receiving it into the future, L, right? You're getting a large one later on, and then has an upfront cost, kind of heavy. Oh, yeah, there's one more thing I got to show you. I forgot. So after this, I'm going to have to go back to something. I forgot. Now let's do the net present value. So we do net present value. So remember that original cost is outside of it. And then I'm going to say plus. And then I'm going to say it's the net present value. And then I'm going to hit the interest rate. I'm going to hit function F4 to freeze it. And then I'm going to hit comma. And then it's all future cash flows. We'll look at that. It gives 100 and then project L. So as you can see, that net present value, remember that's king. Net present value is king. And and we would choose the 280 in that regard. The IRR would be wrong. It would give us the wrong one. So according to our decision, what would we choose? We would choose this one. According to our decision, which one we choose? We would choose the other project, Project S. And according to this decision, we would choose Project L. So what does it say? Loss value. If we use IRR, what is the loss value? That we would lose money. That would be the wrong decision. If we choose IRR, we would lose, and I'm just going to show the difference between the two. That's all it means. What about if we chose the MIRR? Will we have a loss value? If we chose the MIRR, that would give us the highest net present value. Therefore, the loss value is 0. And then if we chose the IRR, that would give us the wrong one. So I'm sorry. The first one was IRR instead of MIRR. So that would be wrong. And now what if we chose the MIRR above the net present value? Well, that would be the same thing. We would lose the difference between what we should have had and what we would get if we had the MIRR. Okay. All right, so that's the only question I was going to do. Oh yeah, what I wanted to show here is something called a crossover rate. If you pull up the PowerPoint, it shows that depending on the WACC, that project S and L could have different results. Let me show you what I mean. I'm going to find out what is the IRR in which the net present value is equal. There's going to be a certain net present value is going to be equal. So how do you figure that out? Is I want to find the difference between the two projects. So I'm going to pick this project and I'm going to subtract out this project. So I'm going to find out the difference and then I'm going to highlight those and go down. Okay. Hold on. I'm going to take off that formatting. There you go. So that's just the difference. And now what I'm going to do is let's do a few things. Let's find out the net present value of these cash flows. So again, that's WACC, and then I'm going to highlight those future cash flows, close it up, and then I'm going to add in at times 0. Hey, when is that percentage that pops up? Okay, negative 120. I don't think that's really important to show. Now let's do the IRR for that. This would be the crossover rate. So I'm just going to highlight those values. This is important in a way, and I'm going to show you what I mean. That is the WACC, the internal rate of return, which net present value, the differences of the two projects are 8.68. What that means is if you had a WACC of 8.68, you are indifferent to either project, okay? Let's show you how that works. I'm going to change the WACC according to this, and I want you to keep your eye on the net present value. If I choose this would be the WACC at which both have an equal, this is the internal rate of return where both have an equal net present value. They're equal with each other, which means if the WACC, here, that's the same one. I'm going to show you what I mean by this. If the WACC is 2% below this, look what project becomes better. Project L is better. However, if the WACC is at that crossover rate, they are equal with each other. And then if the WACC is greater than the crossover rate, look what becomes better. Remember, it was 10%. S becomes better. The higher the WACC becomes, S becomes better, and L becomes worse. Or the difference between the two become a bigger gap, what I should say. So that's real important to see. Now, what does that mean? Why is that the case? Why, if we have a low WACC, this is better? Is because, here, I'm going to show you a couple things. Let's just sum up the positive cash flows. Actually, let's just sum up all the cash flows. We have a net of 50, and look at this one. We have a net of 40. This L project is actually higher cash flows. But why does it have a lower net present value at a WACC of 10%? It's because your cash flows are later on, and you have to discount them by 10%, right? if you're going to give me a bunch of money 10 years from now, that's not worth as much today. Therefore, if you have a higher discount rate, that means that is not as worth as much. And if you notice Project S, even though it's less cash flows in total, the majority of it's up front. Therefore, if you have a higher WAC, this becomes more beneficial because you get it sooner. This becomes less beneficial. But if you have a low WAC, this is not discounted as much. Now look what happens if you hit 0. I want you to think about what that means. The cash flow becomes exactly what we did up here. It's because you're not discounting those cash flows, right? We're not discounting. If it's a 0 WAC, we're saying there's no time value of money. Therefore, that's all it is, the sum of the negative and the positives. Hopefully that makes sense. That's a crossover rate. There you go. If you have any questions, submit that sheet. Any questions, please let me know. And God bless.